I did. I attempted to invest 5% of my portfolio in Russian stocks. In the near term, probably mercifully for me, the market in Russian stocks shut down before I was able to go to a full 5%. The rationale being that the cheapest natural resource stocks in the world, which were Russian, had fallen by 50%. And the rationale further, as we discussed at the time, being that the potential for a 10-bagger in the largest and finest natural resource companies in the world, rather than in a collection of penny dreadfuls, was an opportunity that was too great to miss. I still believe the stocks are cheap, given the political interference, both against foreign investment in Russia and also the delisting of Russian stocks from the London Exchange, and the possibility that Americans will be sanctioned by their own government from owning Russian stocks certainly means in the near term this has been a trying investment. But Michelle, as you know, this isn't the first experience that I have as a speculator with trying investments.
No, and more often than not, you succeed in your speculation of trying investments. So what is your current exposure, if any, to Russia?
I have about 1.5% of my portfolio, I think, invested in Russian resource equities. I don't own any of the Russian general market securities, but I do own Russian mining stocks and Russian oil and gas stocks. And right now I'm in sort of limbo. As an example, Russian is banned from the SWIFT banking system, which means that the Russian companies can't pay me dividends. Or if they do, they pay me in a non-convertible currency, which is to say the ruble. My hope is that the Russian companies will institute a dividend reinvestment program. So if nothing else, I can get more shares, which I can't sell, in a market which I can't access.
Okay, well, there could be a whole alternative financial monetary system that Russia may be looking to implement because of the way that the US dollar and the SWIFT system have been weaponized against Russia. There is some conversation that we're going to see a bifurcation of the monetary system with the likes of China, Russia, Iran, choose your non-friendly West, anti-West player. So all the people that have had issues with the West, that they may form some kind of monetary system, some sort of trade alliance, potentially pegged to commodities. What are your thoughts there?
I absolutely believe that countries that object to the extraterritoriality of the United States should and will develop alternative trading arrangements. My experience over the last 40 years is, despite the fact that those countries don't trust the United States, they trust each other less. And I'll be interested in the architecture of that develops. It's interesting that people who are proponents of that arrangement, and I'm frankly a proponent of that arrangement from a philosophical point of view, but they suggest that it'll be pegged to commodities. If you use the word pegged as opposed to use the word backed, I suspect that it will be pegged. That is to say, a promise to deliver commodities, as an example. What will actually occur, I think, is a series of formalized bilateral arrangements in currencies outside the US dollar, so that the US dollar can't be formally weaponized. I believe that any currency unit that developed outside of the US dollar for many, many, many years would actually end up being a currency that people traded into and out of, meaning that it would be converted to US dollars and back out of US dollars. As I say, my own experience has been that those countries which profess deserved distrust in the United States trust each other even less.
There is no honor amongst thieves, as they say, if that is an appropriate saying to work into this conversation.
And of course, I would include my own country, Americans, among the thieves, yes.
But as you say, they still trust the US dollar the most. Well, one of the things that we have seen as a definite consequence of this war is obviously oil prices rising with the ban of Russian exports. And there is now talk that Russian uranium exports will also be banned. This is a pretty significant deal considering the EU imports a fifth of its uranium supplies from Russia. And the US, I believe, 50% of its uranium, correct me if I'm wrong, comes from Russia. There's growing movement to make the sanctions more effective by now focusing on the uranium sector. Germany, for example, has just thrown its weight behind this demand. Do you see that happening, a ban on uranium from Russia?
I think I do. What we're seeing right now in the market is self-sanctioning, which is to say that many Western utilities are voluntarily not buying uranium from Russia. And the fact that Russia can't be paid for uranium in US dollars means that they're loath to sell it when they can't get paid for it. The issue really isn't so much uranium sales as enrichment. Russia has about 8% of world uranium export capacity, but they have 40% of enrichment and re-enrichment capacity. And right now, the world as it sits can't do without Russian enrichment capacity. There isn't sufficient enrichment capacity elsewhere in the world. The consequence of that is that in the very near term, demand for primary fuel, non-re-enriched fuel, is going to grow in the near term.
What does it mean for uranium at large in the near term? We have seen a drop in the price, I believe 65 to 48 per pound in the last couple of weeks, consistent with the general decline that we're seeing in the market. But what impact do you think that's going to have on the price of uranium?
The uranium market is very opaque. In 20 years of trying, I've never come to understand how much spot market inventory there was. It is very obvious right now that the markets are reasonably well supplied with uranium. The consequence of the potential Russian embargo was to see panic buying, which took uranium from $50 to 62 or 63, and then a relaxation of concerns that saw uranium retrace all of the gains. That would suggest that at least at present, there are ample inventories in the spot market to lead to a hiatus in panic buying. How long that lasts is a very different question. I don't think that anyone, the big utilities, the trading companies, the big producers, know the extent of the spot market. It's interesting too, when you talk about the US reliance on Russia for uranium. This happened as a consequence of a wonderful idea, which was the idea that both the United States and the Russians should blend down their weapons grade uranium, turn bombs into watts. It's been a wonderful circumstance for both countries. And my hope is, maybe hope against hope, that politically we decide that despite the fact that we have some hostilities with each other, that the idea of reducing our ability to kill each other so many times over will lead to us continuing somehow to blend down weapons grade uranium into fuel grade uranium.
Well, speaking of fuel-grade uranium, we have seen more of a move to decarbonize and to lessen reliance on fossil fuels, and the situation with Russia is certainly a strong example of that. Overall, what is your outlook for uranium? I know you're pretty bullish, but if you can give me a closer timeline for uranium-linked companies, and of course there's the Sprott Uranium Fund.
I'm perfectly willing to concede that uranium, the commodity, and uranium equities could see a soft 2 or 3 months. There's been a real change in the outlook around uranium, and for the reasons that you discuss. For my whole lifetime in the uranium business, it's been regarded as a pariah fuel, and I have been regarded as a pariah myself. When I talk about uranium, people act as though I'm championing Chernobyl, Hiroshima, Nagasaki, 3 Mile Island, and Fukushima. There's come to be a realization that the world needs more electric power, and the world needs electric power in a way that doesn't generate more carbon.
Yes.
The government of China, as an example, has suggested that 500,000 Chinese a year die from airborne particulate pollution from power generation. All of a sudden, there has been a realization that in many senses, uranium production and the generation of electricity from uranium is environmentally friendly. That's been a real change of perception, particularly in Japan, which experienced Fukushima. The second thing that's happened very, very recently in uranium is that the fragility of the supply chain has been demonstrated by the exit of the Russians from the uranium market.
Right.
So countries that are concerned about energy security, Korea, Japan, Taiwan, countries like that have suddenly come back to the realization that in terms of energy security, because of the density of uranium, that they have no choice but to embrace nuclear power. So the change has been very big. A lot is made in uranium about the increasing pace of Chinese consumption, about small to medium reactors. These are things that change uranium demand 6 years from now, 7 years from now, 10 years from now. The pace of Japanese restarts and the reversal of the decline of nuclear decommissioning in the West changes uranium demand for the better in 2022 and 2023. And that's much more important in terms of the current price of uranium.
So 2022, as we
Now.
are right now, and 2023, do you see the global slowdown impacting this? There's talk about recession here in the in the U.S. Elsewhere, do you see the potential global slowdown that we're seeing coming out of China as one impacting uranium?
You know, Michelle, I tease myself that I've correctly called 17 of the last 3 recessions. So I would urge your audience not to pay attention to me with regards to recession. If we have a synchronized global recession or a synchronized global depression, it won't be kind to any asset class, including commodities. It is very obvious across a broad range of commodities, uranium, oil and gas, copper, that if the globe continues on its current economic trajectory, there will be widespread shortages in 5 years. There will be supply-led shortages. But if you constrain demand via a recession or a depression, then obviously the supply chains will be much less stressed. Whether or not there will be a recession or a depression, I would rather leave your viewers to decide for themselves.
Well, there seems to be growing calls that we should be on recession watch, especially as the Fed takes on a more aggressive tightening in order to combat inflation, which is now at 40-year highs. So I want to understand your outlook for commodities in a macro environment that we have at the moment. As I say, a Fed taking on a more aggressive posture to fight against inflation. We've had equity markets tanking. What does this mean for commodities and particularly precious metals?
If you believe that the voters and the Fed have a sense of humor for market interest rates, then we're going to have a recession.
Sense of humor. Okay.
Right now, the world's benchmark debt security, the US 10-year Treasury, yields 3%. And the underlying rate of inflation is 8.5%. Back over the last 40 years, the US 10-year Treasury has generally had a positive real yield. To have a positive real yield, you would need to take the interest rate on the 10-year Treasury to 9%. You'd need to triple the interest charge on federal, state, and local debt. I don't think that's going to happen. I don't think that although the economy should be on a real footing, that the economy or the politicians are have a sense of humor to go on that same real basis. I remember, you wouldn't, most of your viewers wouldn't, but in 1975, we had the same circumstance. People began to be concerned about inflation. The Fed raised the interest rate. The gold price fell by half. The equities market tanked. The economy tanked. The Fed lost its nerve, reversed its position, and of course, the gold price doubled.
Okay, so you don't think that Powell is going to go through with it? You think he's going to backpedal? We had, as I say, former Fed Chair Ben Bernanke saying they waited too long to raise rates. And obviously, the more they raise, the higher the chances are of recession. You're thinking he's not going to have the stomach to really do it, even though he's assuring the markets that he is going to be very aggressively focused on taming inflation?
I haven't made a lot of money in the last 40 years by believing that my government tells me the truth. The fact that he said that, I think, isn't any accurate gauge of his intention. I think he should raise interest rates. I don't think he will. I think that the economy that we enjoy today, if that's the right phrase, is a false economy. I think it's an economy that's driven by false liquidity. And I think it's an economy that's driven by artificially low interest rates. And I think voters love the fiction that they're living in today.
So the Fed will continue to kick the can down the road, is what you're saying, and maintain the illusion of a healthy economy.
I think that they could raise the interest rate by 50 or 75 basis points. I think if they do that, the equities markets continue to decline. I think that the long-term debt market gets decimated. I think that the broad economy begins to suffer. I think that the voters complain would be a light word. And I think that the politicians and the Fed react.
So how does the Fed tame inflation then? If not, so we're going to learn to live with a higher rate of inflation?
At some point in time, I suspect that the negative impact of inflation will be felt by individuals to a greater extent than it's felt today. Remember that people's expectation of the future is set by their experience in the immediate past. And so although people see a headline number of 8.5% inflation, they haven't lived with inflation for 40 years. It hasn't bit them yet. What people are afraid of right now is not being able to make their car payments. There will come a time when people see the purchasing power of their savings decimated. There will come a time when people see a 5% wage increase as a 4.5% wage decrease, but we're not there yet. The political superstructure in the country will react to the problem that the voters see today, which is the interest charge that they pay on their first mortgage and the interest charge that they pay on their credit cards.
So for political reasoning, if I may sum up your point, you think the Fed is going to backpedal this aggressiveness, maybe raise by another 1% tops.
Right.
Are we still going to have a recession or just a mild recession?
Ultimately, I think we have to have a recession. The question becomes when. In my experience, you tame an excessively hot economy, which we've had for some years, with a slowdown. Slowdowns are extremely unpleasant. I don't believe that all of the basic laws of economics have been refuted by politics, but I'm old enough to understand that something that is inevitable isn't necessarily imminent.
That is very well said. Inevitable is not necessarily imminent. Well, interest in the rate of inflation has really been frustrating to a lot of gold investors because we seemingly have the perfect storm for gold prices to rally. As I say, we have inflation at a 40-year high. The idea of a recession potentially looming creates more uncertainty. Equity markets very much in the red, crypto markets very much in the red, and we still have heightened geopolitical risks. We still don't know how this Russian invasion of Ukraine plays out. We've got China in fresh lockdowns because of COVID. Iran is restarting its nuclear program. North Korea, just for fun, fires a missile here and there. So there's still a bit of geopolitical uncertainty, and yet gold is staying more or less flat. Now, granted, it is struggling against the strong US dollar, but at what point do you see gold breaking out of this 1800 range and making significant headway?
That's the $64 billion question. I love that question. When we discussed inflation and interest rates earlier, what I tried to say was that people's expectation of the future is set by their experience in the immediate past. And their experience in the immediate past has been benign. I, unlike you, lived through the decade of the 70s in terms of inflation. 1968, 1969, 1970, 1971, the hallmarks of inflation were there. You could see that inflation was coming, but it was an academic topic because it hadn't bitten people yet. And inflation hasn't bitten people yet. When people understand that their 3% increase, wage increase, is a 5% wage decrease in purchasing power terms, when people see their life savings tied up in bonds yielding 3.5%, while the purchasing power of those savings has declined by 8.5%, when they've been victimized by inflation for 2 years or 3 years or 4 years, like they were in the early 70s, then inflation will be front and center on everyone's mind, like it was then. You and I have lived since 1982 in the most benign economic period in the history of mankind. We aren't afraid of much of anything, and you and I are symptoms of the world at large. When the world at large experiences inflation for what it is, against their standard of living, they will respond, Michelle.
They will respond by going into gold?
Among other things, by going into gold. Absolutely.
Well, one of the reasons that we've had discussed that we're not seeing inflation lead to a rally in gold prices and that we're not seeing gold perform as expected has been this idea that the gold price is manipulated. We recently had Frank Giustra on the show, and he says that he does believe that there is manipulation of the gold price via the derivatives market. I know you and I have discussed silver manipulation in the past and the fact that there is more paper silver than there is to cover physical silver. But what is your take on this idea that there could be some grand scheme to intentionally suppress gold prices?
The caveat that you put in place for Frank, which is to say that gold is manipulated in the derivatives market, which is to say that short-term gold markets are manipulated, I wholeheartedly agree with. I believe that all markets are and can be manipulated in the short term. If they can manipulate a market the size of the US Treasury market or the LIBOR market, for sure they can manipulate the gold market. It's different saying that than saying that there has been some long, thoroughgoing conspiracy to depress the price of gold. The very strong US dollar and the lowering of interest rates that's occurred in the period 1982 to 2022 obviated the need to do that. Gold went down all by itself. It didn't need any help from manipulation. Now, a circumstance in the derivatives market where in a market like gold or silver, where 100 times the volume of gold available for delivery trades on a daily basis in futures markets, is ripe for manipulation. The idea that you could short a forward position 6 months out, 12 months out, 18 months out, borrow physical gold, dump it on the overnight market to cause the physical market to kick down and cause the leveraged derivatives markets to kick down. That type of manipulation? Absolutely. The idea that there's some vast conspiracy between governments and central banks and the Trilateral Commission to depress the price of gold when history has depressed the price of gold seems silly to me. I mean, look at the supposed players. The government can't deliver the mail. They can't educate the kids. And they can preside over a 40-year manipulation of the gold price? I don't reckon.
Well, what would be interesting is for you and Frank to hash this one out.
I would be surprised if Frank and I had too much disagreement. I would love to do it. If what Frank is saying is that people can use the derivatives market in the near term to manipulate the price of gold, he and I would be 100% in accord. If Frank believes, and by the way, I have a huge amount of time for Frank. If Frank believes that there has been a thorough, ongoing, politically inspired manipulation to depress the price of gold, I'd love to have the debate with him.
All right, sounds like a potentially interesting conversation there. So, Rick, given this environment that we've discussed, what would you say is the best way for an investor to position themselves?
First of all, as we talked about before, this is really controversial. Investors have to have cash. Despite the fact that cash in the bank is costing you 8.5% of your purchasing power, that negative interest that you experience is an option premium to take advantage of volatility. And volatility we're going to have lots of. So the first thing is have cash. Please, please, please have cash.
Cash is not trash, as Ray Dalio says.
Cash is not trash. Emphasize quality in your investments now. Don't go for stories. Don't go for the narrative. Go for value. Absolutely, positively have exposure to commodities. Absolutely, positively have exposure to precious metals. I run into investors that have 100% of their portfolio in gold, which is insane. But the overall market, the market share of precious metals and precious metal securities relative to other savings and investment assets in the United States is 0.5%. Most investors can't even spell gold in a circumstance where inflation is eating away their savings at an ever-increasing rate. That's a mistake too.
Are there any particular commodity companies that you would highlight?
With the caveat that there's no one-size-fits-all for all investors,
Sure, yeah.
I would suggest that investors who are historically underweight precious metals and commodities emphasize the highest quality commodity companies. In other words, I would emphasize staying away from the juniors, buying names like Exxon, buying names like Chevron, buying names like Occidental, Rio Tinto, BHP, Glencore, Vale, the highest quality companies with the best balance sheets, the longest lived reserves, companies that can withstand volatilities, companies that can withstand a hiatus in capital markets. Right now, with things as uncertain as they are, buy the best, because the best are falling in price just like the rest.